Okay, welcome to the Aramir Roundtable. Today is the 24th of March, 2021. So welcome everyone. We have a new presenter, Benedict from Singapore. He's going to show us his lazy lion trade. So Benedict, maybe tell people a little bit about yourself and yeah, go ahead with the presentation, and I'll mute myself, but I'll still be here just so there's no background interfering.
Yeah, sure. Okay, so my name is Benedict. Before I go into the lazy lion trade, just a few disclaimers. So Aramir is not a broker and dealer. The webinars and seminars given by Aramir are for educational purposes only. Options involve risk and are not suitable for all investors. And past performance is not indicative of future results. And all information in this presentation is for personal and non-commercial use only. So I'll just pause here for a second for everyone to just read the disclosure before I move on.
Oh, we're still seeing the title slide.
Sorry? Oh, you're not seeing it?
Yeah, we're seeing your PowerPoint. So we just see all the slides on the left, and then the place you edit it.
Are you seeing the disclosure document?
Well, not as a full slide. We just see the basically the title.
Okay, I think what I'll do is I'll just
That's good. Yeah, now we can see the disclosure. Okay, yeah, that's fine.
okay, yeah. So maybe I'll just go on a bit about myself. So I'm actually an investor and an options trader as well. The strategies. So maybe I'll just start with how I got into investing in options trading. So initially, I started investing in about probably the year 2017. And during that year, I was still kind of, trying different things out. I didn't really get into options until probably about 2019 or so. And that was when I started trying out different option strategies. And basically what I found is I basically stumbled upon quite a consistent strategy, and that involves option selling. So basically it's a high probability kind of options trade. And the goal of this strategy is actually to generate consistent income from the markets. And it's actually quite a simple strategy because I believe in actually the KISS principle, which is keeping it simple and stupid. So I believe in keeping things very simple and fuss-free. And also, as I'm sharing with you my trades, as I'm giving you trade alerts, and I believe in having skin in the game. So basically for every trade that I send out, I will be actually placing a similar real money trade in my personal account as well. So with this, we can see that there is an alignment of interest. And the goal of this, my goal is actually to provide, to help people achieve their financial goals through investing and trading. So before we actually place a trade, what are actually the possible outcomes? So there are actually 5 different possible outcomes. The first is you break even on a trade. The second is a small win. The third is a small loss. Fourth scenario is a big win. And the fifth is actually a big loss. So with these 5 outcomes, once you are able to eliminate the 5th outcome, which is the big loss, we have actually taken a big step forward, and it will show in the profitability of our trades as well. So why sell options? So options are actually decaying assets. So as you can see from the graph, the y-axis shows the option value, and the x-axis is actually the time to expiration. So as you can see, that as time passes, the theta decay will actually speed up, and the option loses its value exponentially during the last 120 days before expiration. So I'll just go through the basics for the benefit of the newer people here who are new to options. So for those who are actually more advanced and experienced, if you could just pardon me while I go through the basics of what these strategies are. So I'll be going through credit spreads basically. So these are bull put spreads, bear call spreads, and iron condors. So iron condors is basically a combination of the bull put and the bull call spread. Spread is actually a two-legged strategy that involves selling one option and buying another option. And there are two types of credit spreads. So the first is a bull put spread, also known as the put credit spread. The second is a bear call spread, also known as a call credit spread. So with a bull put spread, we are actually selling a put at a 30 delta and buying a put at a lower strike price. And what is our maximum risk? Our maximum risk is actually the width of the strike prices of the two puts. And when do we actually put on this trade? So we actually put on this bull put spread when we actually have a neutral to bullish outlook on the underlying. So the underlying could be a stock or an ETF. So these are the two main underlyings that we actually trade. So let's go through an example number one for the bull put spread. So let's say the current stock price is at $120 and we are selling 100/95 bull put spread. So this means that we are actually selling $100 put and buying a 95 strike put as a reinsurance. So the premium received, let's say we collect $120 of premiums, and our max risk is actually computed by the difference between the two strike prices times 100, as one contract controls 100 shares, less our premium received. So in this case, our max risk will be $380. So that's the maximum amount that we can lose on this trade, and the maximum amount that we can actually win on this trade is actually our premium received, which is actually $120. Next, for the bear call spread. So for bear call spread, we will actually sell a call at a 30 delta, and we'll be buying a call at a higher strike price. So the same thing, the maximum risk is the width of the strike prices of the two call options. When do we actually put on this trade? When we have a neutral to bearish outlook on the stock or ETF. So as an example of a bear call spread, let's say there is a current stock price is at $80 and we are selling a 105/110 bear call spread. So in this case, we'll be selling a call option at 105 strike price and buying another call option at 110 strike price. So let's say our premium received is $110. So our maximum risk will be the difference between the two strike prices times 100 shares, less our premium received. And in this case, that would be $390. So similarly, our max risk is $290, which is the maximum we can lose on this trade. And the maximum amount that we can actually earn on this trade is $110. which is our premium that we have collected. Next, we'll move on to iron condor. So actually, iron condor is actually a combination of both the bear put, the bull put, and the bear call spread. So what actually happens with an iron condor is actually we are actually pinning a stock within the range. So for example, if we are selling a bull put at the previous strike and 90, and we are selling a bear call at different strike prices above the current strike price. Later on, we actually go through an example of this. So the maximum risk is actually the width of the strike prices. And we put on this trade when we actually have a neutral outlook on the stock or ETF. So an example of an iron condor. So let's say the current stock price is at $140 and we'll be selling an iron condor. So this involves selling both a bull put spread and a bear call spread. So a bull put spread will involve selling 100/105. So we are selling 110 put and buying 105 put to actually cap our risk. And above the current stock price, we'll be selling a bear call spread. So this involves selling a call at a 185 strike price and buying another call at a 190 strike price. So ideally, the ideal scenario would be that the underlying stock or ETF remains between our short strikes. So in this case, our short strikes are $110 on the put side and $185 on the call side. So as long as the strike prices remain between 110 and 185, we will achieve we get to keep the premium that we actually collect. So let's go through a real money trade that I actually executed for an iron condor on the SPY. So on the 27th of October last year, I actually I sold an iron condor on the SPY with a DT at 20th November 2020. So at that time, SPY was trading around $338. And I actually sold a short put and a short call strikes at 15 delta. So basically selling these strikes at a 15 delta gives me a 70% probability that this trade will actually be profitable. So as you can see, I have sold a 307/302 bull put spread. And on the call side, I've actually sold a 360/365 bear call spread, collecting $70 of premium. So at the 9th of November, which is 11 days to expiry, SPY was actually trading at around 360. So our bear call spread, which we initially sold at the 360/365 strikes, are actually being challenged. So they are at around a 50 delta. So at that time, it was around at the money. So since the SPY has risen in price, the previous bull put spread that we actually sold for $53 has now gone down to only $4. So how do we actually adjust? So we actually adjust by buying back our bull put spread. We adjust by actually rolling up our bull put spread to new strike prices of 345 and 340, collecting an additional net credit of $40. Sorry, this should be a bear call spread. There's a typo there. So we actually roll down our bear call spread and collect an additional credit. So for the bull put spread, we're actually not going to touch our bull put spread. We'll just be rolling down our bear call spread. Sorry, that's a typo there. So we will not be adjusting our challenge side, which is the bull put spread, because the price is actually going up. So at expiration on 20th November 2020, SPY was trading at 357, and we end up closing up the trade at about break even. Sorry, let me just repeat this whole slide again. So I think I've got that wrong. So since the price has gone up, our call spread is actually the one being challenged. So we will not touch the call credit spread. Instead, we will actually be rolling up our put credit spread to the new strike prices of 345, 340, which was at around a 15 delta at that time. And from that adjustment, we actually collected a net credit of $40. So this is inclusive of buying back to close the 360, 365 bull put spread. So we don't actually touch the challenge side, which is actually the bear call spread. So next, we'll just go through a put credit spread example on QCOM. So on the 5th of February 2021, I've actually entered a position to sell a bull put spread on QCOM at a 135-130 strikes, date to expiration 19th of March. So at the time, QCOM was trading at around 145, and the short put strike of 135 was actually at a 30 delta. So how do I actually enter this trade? So I actually sold a 135-130 bull put spread, collecting $125 of premium. And when I actually got challenged on the 9th of March, I actually sold an opposing bear call spread, collecting an additional $32 of premiums. So this bear call spread is actually sold at a 30 delta. So at the time, the 30 delta strike was the 137 call option. So I actually sold a 137 call option, and I bought a 142 call option to actually cap my risk. So at the expiration on 19th of March, QCOM is still trading below our initial put strike price of 135. And the bear call spread that we sold is now worthless. So the bear call spread, which is 137, 142, that we actually sold as an adjustment trade, is now worthless. And it is to be closed for about $1. So what did I do with the bull put spread that was being challenged? So I actually rolled it out to the following week, collecting in 2 days, 26th of March. So my total premium collected from all these adjustments is actually 166. So it's actually $166. So the aim is actually to buy back this bull put spread for $166 or less. So from all the collection of these credits, we are actually reducing our risk from the initial $500. So even if I manage to close it, if I actually don't manage to close it for less than $166, if I close it for slightly more, that's still fine. It's still gonna book in probably a small loss. So this is actually the mechanics of how we actually adjust the trades. So for the lazy lion trade, the contract cycle will be between 30 to 45 days to expiration. So every trade that we will enter is between 30 to 45 days out. And the planned capital will be between $500 to $800 of buying power that will be blocked per trade, per contract. And the minimum account size needed for this strategy is actually $5,000, although $10,000 would be more ideal. Profit target for this will be 50% of premium. So which means that once the trade hits 50%, we will actually set a GTC order to actually close it out. So we will not wait until expiry to actually close out the trades. And the losses will be managed via adjusting trades, which you have seen earlier. So why choose Lazy Lion? So for Lazy Lion, the underlying includes both stocks and indices. And the aim of this strategy is actually more for income generation. And there's little to no guesswork involved, because selling at a 30 delta, you will get a 70% probability of profit. And this strategy is ideal for both small and large accounts. And there is not much screen time required for this strategy as well. So next, I'll move on to the entry rules. So when do we actually enter this trade? So we enter this trade when the price is actually at a strong level of support. So how do we actually tell it? We use either the exponential moving averages and trend lines to identify our support and resistance channels. So we will choose a short strike at a 25 to 30 delta. So this gives us a 70 to 75% probability of a winning trade. But in reality, we actually win a significant percentage higher than it. So we will see around an 80 to 85% win rate. So this is actually due to the implied volatility premium. So the implied volatility is actually overestimating the amount that the price will move. Capital allocation per trade is between 1 to 5%. So ideally on a $5,000 account, a 1% would be $50. So you probably cannot do 1%. So a $5,000 account, you'll probably have to do maximum $250 risk per trade. But as mentioned previously, because generally the buying power block is $500 to $800, it is ideal to have at least $10,000 as your total capital. So at any point in time, the maximum capital allocation is between 50 to 70% of the total capital. So on a $10,000 account, that is about 5,000 to 7,000 of buying power that will be blocked. So the exit rules. So like I mentioned previously, if the position is in profit, you will take profit once 50% of the premium has been realized. If the position is in a loss for credit spreads, 2 weeks before expiration, because remember for credit spreads, we are actually selling at a 30 delta. So the delta of the option is at 45 or more. 2 weeks before expiration, we will adjust by selling the opposing credit spread. So if we have sold a put credit spread previously, we will sell the opposing credit spread on the call side and vice versa. So what's the purpose of actually collecting more credit? So collecting more credit actually reduces our total risk in a position. So because our maximum loss for a $5 white spread is actually $500. So by collecting more credit, we're actually making our total credit closer to $500. So that will actually prevent us from losing the maximum loss if the position goes against us. And for iron condors, 2 weeks before expiration, we will adjust the challenge site. So the challenge site will be at a 30 delta or more. So likewise, this allows us to collect more credit while reducing our risk in the position. So if at expiration, your position is still in a loss, what should you do? So there's 2 options, no pun intended. The first one is to roll out the position to the following month to collect even more credit. So this actually buys us more time for the probabilities to play themselves out. And the second alternative is to just cut your losses and close the trade. So this is the equity curve of the Lazy Lion performance since its inception in September 2019. So since inception in September 2019, Lazy Lion has returned 23% in 1.5 years. So that works out to be about 15% per year. And don't forget, this takes into account the COVID crash in March 2020. However, we are unlikely to see crashes of this magnitude too often. So generally, going forward, we can expect returns of around 20 to 30% annualized. The results for this strategy is pretty promising as well, as shown from my previous real money trades. So the strategy has actually had a win rate of 85% with a maximum drawdown of 20%. Average win per trade is $59 and average loss per trade is $178. So why does this strategy work? So from our previous numbers, you can see the average loss is actually almost 3 times the average win. However, this is because the strategy has a positive expectancy. So a positive expectancy means that our trading system actually has an edge in the market. So no matter how good the risk to reward might seem, it is useless if your trading strategy does not have a positive expectancy. So I'll go through what is this positive expectancy all about. So as shown, 85% of the time, we actually win $59 for this particular strategy. So the remaining 15% of the time, we will lose $178. So our expectancy is calculated by calculating the probability of winning and multiply that by the average win minus the probability of loss multiplied by the average loss. So for this, if we get a positive number, it means that we have a positive expectancy. So in this case, we are getting 23.45. So this means that we actually have a positive expectancy. So it's actually quite a simple system, but we're actually seeing a very good numbers that is resulting from this strategy. So like I mentioned previously, you can expect returns of 20 to 30% annualized, which translates to around 2 to 3% on a monthly basis. So in 2020, we only had 1 losing month for this trade, and that was during the COVID crash in March 2020. So who is this strategy actually for? So this strategy is for you if you are actually trying to generate consistent income from selling options. This strategy is also for you if you want to remove emotions and subjectivity from your trading. It's for you if you can affect making slow and steady returns while also managing your risk. So it is great for time-starved individuals who don't want to spend all day staring at the market. And who is this not for? So this strategy is not for someone who is actually looking for a get-rich-quick scheme and actually someone who wants to make fast returns and seeks excitement. So nowadays we are seeing a lot of Robinhood traders coming out with 100% returns, 1000% returns. So this strategy will not actually help you achieve that. So if you're looking for that kind of returns, maybe you're looking for something else. So what you get with the Lazy Lion Trade Alert service. So we don't actually trade every day. So typically on a monthly basis, typically you can expect around 8 to 15 trades. And there'll be real-time alerts sent via email and or text messages for all opening, closing, and adjusting trades. And it also comes with videos and guidelines on how to use the service. So actually, the normal price for this service is actually $129 per month. However, on a monthly basis, this will be reduced to $99. However, for the first month, there is a special rate, and it's only actually $49. So the whole service is actually $49 for the first month. So you can just test it out for the first month. And if you don't like it, you can cancel anytime. And if you like it, going forward, it will be $99 per month. So moving on, maybe can I just take some questions from the floor?
There was one question, how long has this strategy been implemented? So I know you said about 1.5 years you've been trading it.
Yes, that's right.
And I think you have, do you have any data that you tested before that?
Unfortunately, because I wasn't actually trading options before that, so I didn't actually backtest this strategy for anything before September 2019. But I think this actually is quite robust already because it accounts for one of the biggest crashes in March 2020. So I think even if you were to backtest it, it should show pretty good results as the market has been going on an uptrend for probably the last 10 years or so before 2019.
And then what would the biggest drawdown, the peak to trough drawdown that you had, would you say?
So the maximum drawdown for this strategy is actually 20%. So I think that was what I experienced during the crash in March 2020. So any other questions besides this?
I don't see any. So I guess fairly straightforward strategy. How do you pick the stocks or indices that you're going to trade?
So generally, I'll actually look at the stocks that I actually like. So it's actually based on personal preference. So basically, fundamentally good stocks like Amazon, Facebook, Microsoft, Adobe. So basically, I'll just have a scanner which I will scan in my brokerage platform. And if any of the fundamentally good stocks, if I see they are at a key support level, I'll actually enter put credit spread. So actually nowadays, I don't really do a lot of iron condors and call credit spreads. So I do mainly put credit spreads, but occasionally I'll have some call credit spreads and iron condors as well.
Again, Andre asked if he could see the P&L graph again.
Yeah, sure. So,
And I think that was live trading, that wasn't back tested.
yeah, this was live trading, so it was from my own personal trades. So I think there was only one drawdown, which was probably in March 2020, where the peak to trough, I think the peak to trough was, yeah, pretty much about
Maybe 12, 13%.
probably less than 20%. Yeah, probably 12,
Yeah.
13%. Yeah.
It's pretty good since the market was down like 35%.
Yeah, but that's because I closed my trades at a 50% realized premium.
Right.
So I didn't have a lot of open trades at that point of time.
And then is there a specific day or time that you put the trades on or off?
Not really, but for a bullish position, I generally like to take a position when the market is actually down. So that way I can, implied volatility will probably be higher and the trade has actually more chance of working out.
Okay, and then there was another question. Not sure if you mentioned it. Are you legging into the put credit spread first on support and then doing the call credit spread? It sounds like you're starting with the put credit spread and you only put the call credit spread on if the put credit spread gets in trouble.
Yes, that's right. So that was the QCOM put credit spread. Yeah, that was this one, right?
Yeah.
Yeah, so the initial position was actually QCOM bull put spread at 135, 130. And subsequently, when the position got challenged, I think it's trading around 130 or something. And then I sold a bear call spread. But I will only adjust probably between 10 to 14 days before expiration. So I won't adjust immediately once the position goes bad. So I will just give it a bit more time. And once it hits around 2 weeks before expiration, that's when I'll actually put on the opposing adjustment.
Got it. Okay, I think that's all the questions so far. Andre says, nice, thank you, gentlemen. Appreciate you guys coming.
Yep, thank you. I appreciate you guys listening.
Any last words before we wrap it up? I don't think so. So no need to keep everybody here if there's no more questions. So thanks, Benedict. We'll get this recording posted as soon as we can. And yeah, give it a try. It's looks like a nice, simple system. Easy to get filled on vertical spreads. So it's yeah, a nice alternative to add to your trading basket. So thanks, Benedict. Really appreciate you presenting.
Yep, thank you, Tom. And thank you all for your time today. I appreciate you listening to my presentation.
All right. Thanks, everyone. We'll see you next time.
All right. Thank you. Bye-bye.